Well, they say form is temporary, style is permanent. And this is something which my guest on the show today has clearly adopted, a distinct style in terms of market approach. He spent over almost 3 decades now understanding market, looking at the peaks and the turfs, the bull and the bubble, and identifying ideas which essentially can be consistent compounders. It gives me great pleasure now to bring on board after almost 9 years now, Chirag Setalvad on ET Now. Thank you very much for joining us. क्या बात है, आप ऐसे ही दिखते हो.
Thank you, Nikunj. That's very kind of you.
Let's start with a very simple question. Markets, they follow a cycle, boom and bust. Bull market and bear market, they coexist. In your understanding of so many market cycles you've seen, where are we right now?
You know, Nikunj, you can actually trifurcate markets into 3 simple categories. Markets are cheap, and you have a fantastic return if you invest in that kind of environment. Markets are reasonable, in which case your return profile will also be reasonable, and markets are expensive. I think it's difficult to right now justify that markets are cheap. We are somewhere, we are, I think, now beyond the point where markets are reasonable. We are in some degree of expensiveness. So as you get more and more expensive, naturally you have to compromise on your returns to some extent. So clearly today at valuations which are, large caps are not that expensive, but mid cap, small caps certainly are. And I think we're not in a bubble zone, I don't think, but we're certainly in a market which is expensive. And hence we need to temper down our expectations of returns. We're no longer in a market which is reasonable because we are now trading Nifty trades at a 10% premium. Small cap and mid caps trade at a 25 to 30% premium. So those are reasonable numbers. I think large caps are still reasonably priced, and that's 70% of the market. So the excess is in a smaller segment of the market, which is in mid cap and small cap. So I don't think we are in a bubble zone, but we are certainly in an environment where we need to be careful.
When you say markets are trading at reasonable valuations and perhaps premium valuations in some pockets, what are the chances that earnings can actually surprise us, and what is looking expensive in hindsight actually would not be that expensive?
You know, it's remarkable. As an industry, we have got earnings wrong, I think 7 out of 7 years, right? We understated earnings, we overstated earnings for a long period of time, and during COVID we understated earnings, and earnings came far better than expectations. So there is of course a possibility that earnings will surprise either positively or negatively. But when you think about it, corporate profitability today as a percentage of GDP is at a multi-year high. So it's unlikely that margins will surprise. So the surprise really has to come from revenue. It's unlikely to come from margins.
So should one be mentally prepared for no returns or negative returns in small and mid cap stocks for next couple of years?
So let me give you a slightly more bullish perspective on mid cap, small cap. So one argument is that mid cap, small caps trade at a 25, 30, 35% premium, and hence we should be worried. But the other way of looking at it is that, if earnings growth is typically 15, 20%, and if you grow 15, 20% this year as well, if the market remains flat for a year, the correction as a result of time will be 15, 20%. Mm-hmm. And let's say 10, 15% premium to the past is justified because of India's growth profile and so on. So maybe the worst case is that for 1 year we have no returns, right? So that's a more sort of optimistic way of looking at it, that we have a time correction, 1 year not much happens, and hence the market comes to a more reasonable level. Of course, the more negative perspective is that, valuations have moved up. There is a lot of frenzy, which is visible in certain pockets of the market, too much retail participation, too much sort of primary market activity and so on. And hence there will be a meaningful correction. So only time will tell, unfortunately.
Some purist on, or the Parma Bulls on Dalal Street, they tell me that Nariman Point sea-facing flat will always trade at a premium. And other flats of Mumbai will trade at a discount. In India right now is that Nariman sea-facing flat. So don't worry about valuations, enjoy the joyride in the bull market. How would you defend that?
Markets will always hit new highs, but there are going to be hiccups along the way. I think this thinking that we are going to every year, we had a positive return in 8 out of 10 years or 9 out of 10 years. So we need to take a breather at some point of time. That doesn't mean that India is not a fantastic market to invest in. If you're a 10-year investor, if you're a 15-year investor, this is a fantastic market to be in. But there will be points of time when the market will correct 15, 20, 25%, and there will be blood on the street. That's going to happen. So I think the key investing people keep forgetting is how long you invest. If you had invested in the IT bubble at the top in 2000, in 20 years later, you still had a solid return because you held for that duration of time. We still think of long term. We used to think in a couple of years, now we think 3 to 5 years. Long term is 10, 15, 20 years. If you're a 10, 15-year investor in India, you should be extremely positive. But that doesn't mean that the next couple of years cannot be a little bit difficult or the next year cannot be difficult.
You started the show by saying that there is no bubble in the market. I'm just going to spend some time here for the perspective of our viewers, because this is also typical telltale signs what both of us have observed, that when these signs are at play, it ends badly. Retail participation, frenzy of IPOs, new NFOs, and in terms of exciting things which keep on happening about the whole macro appeal. And on top of that, you got FNO activity where trading activity is like never before.
Yep.
When the combination of this circle starts, it's like a bubble which gets pricked. But you are of the view that we are not closer to a bubble.
See, a bubble is a very extreme definition, right? So I think we want to apply that definition very carefully.
Okay.
Are we in a market which is expensive? Yes, there is significant excess, and there are pockets of the market where there is, very material excess. But to say bubble, really, you have to be in a situation, or a bubble is something where there is zero justification, where things are really bizarre, and so on and so forth. So I don't necessarily think we are in a bubble. Does that mean I'm content with valuations or happy with valuations? No, I think we are in a dangerous zone. But are we in a bubble? I don't think so. But we are certainly at a significant premium in certain segments of the market. Certain sectors are expensive. Mid cap, small caps are expensive. So you should be nervous. I think this is a decent time to be nervous. But I don't think you have to be, categorizing it necessarily as a bubble.
So if luck made
That's
money,
an extreme definition, right?
It's an extreme definition. You don't see signs of 2008 or 2000.
I mean, I don't think you have to, every market is different, so I wouldn't want to categorize it as like 2008 and as 2017. Each market is different, but, like you said, every sign of excess is there. You can see the excess in valuation, you can see the excess in retail participation, you can see the excess in the SME market, you can see the excess in flows, you can see. So, if you had a checklist of sort of 8-9 things which would highlight, that we are in the danger zone, we're ticking most of those boxes, right? So that's not a good sign. But again, I'm very circumspect to say bubble. But I thought the market was expensive 3, 4, 5 months ago, and it's surprised everybody and continues to rally. But I think there are times to be, when market is cheap, you want to be aggressive. When markets are reasonable, you want to be reasonable. When markets are expensive, you want to be conservative. So, there is times to be in the first gear and then times to be in fourth gear. And I think this is a time to be a little bit more conservative.
So I'm just going to steal a phrase of yours which I've heard and I've used it seamlessly on television, that 80% of the money is made by asset allocation. So what should be the right asset allocation for 3 to 5 years now?
Well, it depends on your profile, right? So, it depends on your age, depends on your risk appetite, depends on your liquidity requirements. Do you have large purchases around the corner, and so on and so forth. But, the younger you are, the closer you should be to 100% equity. And as you become a, octogenarian and so on, as you become older, you want to have 100% of your money in fixed income, right? So it all depends. You have to look at each individual's profile. But asset allocation is the most important. People spend too much time trying to select the right fund and the right sector and so on and so forth. And they don't look at the bigger picture. So get the asset allocation right is the most important. Invest systematically, and I think that now has at least fortunately caught on, is the second most important. And the third, which we don't do very often, is to take advantage of market dips, right? So, how many people invested at the bottom of COVID? How many people invested at the bottom of the financial crisis, right? It's tough times to invest in, but it's fantastic from a return standpoint.
Let's talk about the current setup. You've always been a proponent of growth and value both. What is growing, find it cheap and let it grow. So what to your mind right now is looking interesting in terms of a combination of reasonable valuations and visibility of growth for next 3 to 5 years?
So you want to have a very skewed portfolio. You don't want to have an all-growth portfolio. You don't want to have an all-value portfolio. I think having a mix is important, right? So from an investor standpoint, also to choose funds and fund houses which have different styles and different orientations. That's what creates diversification. Having 4 funds of the same style is not diversification, right? But there are pockets. So there is no particular sector which really stands out. I think financial services is one area, but even that is really the large cap financials where there is some value. To some extent, I would say consumer. Consumer has been a laggard. The rest of the sectors have done extremely well. So to that extent, consumer looks a little bit better. But of course, rural demand continues to be weak and so on. But I think those are 2 interesting hunting grounds. But even in sectors that we don't like, there will be companies that we like. And of course, in sectors that we like, there will be companies that we don't like. So you have to be very, very stock specific. So unfortunately, that's the one thing we can't talk about. But I think this is all about being very, very stock specific.
If I look at your portfolios and I take the clock back, there was a lot of so-called PSU element in it. PFC, REC, State Bank of India. Now that could be an individual company specific call, but it was a call in general that PSU stocks had become cheap. Now they are the darlings right now. Imagine the ugly duckling becoming darling. You've seen that happening before. Where are PSU stocks headed? And what is the next ugly duckling which could become the beautiful swan?
Sure. I think it's very unfair to categorize PSUs into one bucket, right? You have PSU defense stocks, you have PSU banks, you have PSU utilities, you have PSU logistic companies. They have very, very different profiles, right? So we never took a call that we want to own PSUs because this basket is cheap. We liked individual companies. So we like company A, company B, company C, and that's why we populated our portfolios with those companies. Now, similarly, at this point of time, of course, there's been a fantastic rally. And we think some PSUs are overstretched and we don't want to own them and we are trimming them or selling them entirely. And there are others which we feel have a long way ahead of them, and even though they may be expensive, we still would like to hold on to them. So it was stock specific to begin with, it remains stock specific now, and it will be stock specific going forward as well. So I don't think it's fair to really categorize them all in one.
The buzzword is defense, the buzzword is power, the buzzword is railways. Now all these businesses are different profiles, but somehow they hunt together. What's your view on defense and railways, especially as sector?
See, I think the underlying demand is there, right? And we are seeing a lot of sort of tendering which is taking place in these industries. But the question is at what price, right? And these stocks have doubled and tripled and quadrupled and so on. So I think valuations in these segments, the fundamentals are strong, the narrative is fantastic, but the valuations are not supportive. And hence, in select names, I think it makes sense to sort of reduce exposure. But the trajectory and the profile over the next couple of years from a growth standpoint, can still be quite strong. So you want to do it a little bit gradually.
So can I say that markets in defense and railways and some PSU names, they are pricing in FY26 and FY27 earnings? They just run too much ahead of themselves.
Of course they are. More than adequately pricing it in.
So if they correct 20-30%, they get into time-wise correction for a couple of quarters, you will not be surprised.
Absolutely. Even within defense, there are names that we like, there are names that we don't, right? So that's true for any sector. This is not the only sector. For every sector, there will be something that we like and some things that we don't. But when a sector as a whole moves up sharply, then the buys versus sells, the interesting versus less interesting, it skews in the other direction.
Who has the right to win in financials? Because now you've got fintech on one side, you've got small banks which are ramping up, and you've got large banks which still have access to cheap cost of liability. 3 years out, 4 years now, how do you think the banking space would evolve?
I think there's space for everybody, right? I think the private and public sector banks, their franchises from a distribution standpoint are extremely strong. The liability franchise is very strong, and I don't think that is going to change very quickly. So I think there's a space for everybody. There's a space for technology-savvy financial institutions, and there is a space, of course, for the old-fashioned banks as well. So I think everybody, this market is growing fast enough to allow everybody. But I think the key is to just, keep executing, and it's not that easy always, right? But in the technology space, things change very, very rapidly. So we'll have to see.
Now, the purist who's tracked technology tells me the following, that look, this is just a passing phase. It happened with Y2K, they evolved. It happened with enterprise, they evolved. It happened with digital, they evolved, and they survived COVID. So AI is something which will be part of every Indian IT services DNA, and they will fly in next coming quarters. What is your understanding?
I don't think any of us know what AI is. We know what ChatGPT does, and it's entertaining and so on. But how it's going to change the landscape, how it's going to change businesses, it's very, very early. And who are going to be the winners at this point of time? In the Indian context, at least, it's impossible to figure it out.
But Indian IT companies still
this is all buzzwords, right? It's very fashionable to ask this question. Everybody wants to ask in every management meeting, how is AI going to disrupt your business? The managements don't know. So, the fund manager certainly doesn't know. So I think we have to put the AI, and we realize that it's something that is important and that's something that's going to change a lot of industries, but we'll have to see how it evolves. I think let's make a call when it's a little bit more, apparent.
So when would you have a clear view on IT? Because these companies still have cash, buybacks, and they still generate good return ratios.
You take a call on IT aside from AI, right? You don't take a call on IT because of AI. So there are companies, if you feel that they can continue to grow at 10, 15, 20%, and these are cash flow generative businesses, but the valuations have become challenging. Large cap not so bad, mid cap and small caps are trading at premiums to large caps, trading at premiums to the historical averages, and that worries me. So this is not about AI or not AI. How much will AI be of these businesses, right? It will be 5, 10, 15%. And even those are 15% is a large number. So you take a call on IT for IT, right? You look at the dog, you don't look at the tail. So you want to see how the traditional IT business is doing, how is discretionary spending doing, how is the US economy is doing, how is financial services, the large sectors which contribute to IT spending, how are those doing? So I think focusing on AI, you're drawing attention from what you should be looking at, right? And there are no pure play AIs, and AI is now ingrained in some of these businesses, but it's still a very small portion.
How would you now approach the good old consumption space? Staples are expensive, discretionary is where value is not left, but there is a luxury binge which is happening. It's a very interesting space where as per capita changes, the paradoxal shift will also happen.
So I think consumption has been out of the sun for a while, and it will find its spot once again, right? You're not going to have India growing at 12, 13% and leave behind 65% of the population. I mean, it'll be a disaster. Right, so rural has been hit by inflation more than anything else, and as inflation comes under control, that will also be a segment which will come back. And a lot of the consumer names have been relative laggards. They're not cheap, but cheap to other sectors, or cheaper than what the other sectors have been. So in that sense, I think consumer is a little bit contrarian, but can prove to be quite rewarding. These are also great businesses, right? Great businesses, great managements, great communicators, but I think valuations are a little bit better than what they've been in the past, but again from a relative standpoint, not from an absolute standpoint.
You took a stand, and that's a very interesting stand and a very contrast stand. We don't talk about it, so I'm going to just explain it to our viewers. The stand on ESG. The world was talking about वो कुछ मत लो जिसमें धुआं निकलता है. But your funds had exposure to ITC. Your funds had exposure, I think the AMC had exposure to NTPC. A lot of so-called companies which did not qualify the ESG cut, you bought them. What prompted you? And do you think this ESG deal is a real deal?
It's waxed and waned, right? So there's a lot of attention on ESG, now there is less attention and so on. Our aim is to make risk-adjusted returns for investors. And if we can make it in a company which is in tobacco as an example, we'll do it, right? We're not going to do things where you're destroying the environment and hence that impacts the franchise over a period of time. But there's some businesses which are inherently sin type businesses, whether it's from an environment standpoint or from a social standpoint or what have you. As long as we feel that ESG is not something which is going to impact the longevity of the business or the nature of the franchise or the value of the brand, if those things are not getting impacted, then we'll factor that in, right? So we're not oblivious to ESG, but at a price, right? So if you're getting, the ESG concerns are sort of overstated in the price, that's an opportunity. If they're understated, then that's not an opportunity. So, we are not Puritan, and we're not going to stay away from a large segment of the market for ESG. Because of ESG reasons, but we are cognizant of ESG. I think it's an important responsibility that all of us have.
India has done very well in software exports. They've done reasonably well in pharma, but when it comes to manufacturing, we are just about getting started. Is manufacturing at a renaissance, or you think that there is too much of hoopla around it?
I think words like renaissance are too big, right? Yeah. I'm very careful to use, structural changes, and I think these are very, very large words to use. But I do feel that there is a big change that is taking place, right? The government is very focused on making India, everybody's aware of that, right? We are seeing this big change of China Plus One. And it's not just a story, right? The China Plus One started off as a hope and is now becoming a reality. And we see that reality when we meet companies, right? The traction that these companies are getting either from inquiries or on the ground investments and so on. So I think all of these things are playing out, right? And unorganized to organized is a clear trend which is taking place. So all of these are helping manufacturing quite significantly. But again, you have to get very, very specific. You have to get granular and look at it at a stock level. But I think as a theme, manufacturing is certainly a theme which is very interesting.
Couple of last follow-up questions. You always have to identify based on macro and the template where there is a natural headwind and where there is a natural tailwind, which is going to affect the business. Which are the sectors, themes you think have a natural headwind for multiple years? And which are the sectors where the tailwind is significant?
I'll tell you where there is a natural tailwind. Certainly, and this is not a revelation, everybody knows this, right? But there's a huge tailwind which is clearly visible in investment-related businesses, right? Because
when you say investment-related businesses?
Well, government is spending, as everybody knows, government is spending a tremendous amount of money on infra, and hence businesses related to infra and investments are doing extremely well. So that's the first part. The second is private capex has been a laggard, and it's been a laggard now for 3, 4, 5, 6 years, right? It's been the great hope, and it's not panned out, but eventually it will, right? It's not like we're never going to spend capex on the private sector side. So that will be the second leg which will eventually drop. So I think the capex story can continue for many, many years, and that will bring in a lot of people, right? It will bring in construction companies, it will bring in equipment providers. So I think that's a story which has many, many years and strong legs to it. So I think that's clear tailwinds visible there.
What about headwinds?
I don't see any sector which has massive headwinds to it per se. I mean, these are I think they're cyclical headwinds which take place, but I don't think they're structural permanent headwinds which are visible. So banking may be going through some issues from a deposit growth standpoint, and you may be seeing some growth slow down from a consumer standpoint, but these are all cyclical in nature. It's not that deposit growth is always going to be slow. It's not going to be that rural demand is always going to be slow. Economy growing at 12-15%, you're not going to find a large sector which is facing huge permanent headwinds. It will face cyclical headwinds because some businesses are cyclical in nature, but I don't see any sector with strong permanent headwinds attached to it.
So in general, I go back to that first point before we start wrapping up. Very important for us to hear from Chirag Setalvad in terms of what the positioning of the market is. You don't feel there is a bubble. You think that one should emphasize on risk management, take some chips off the table and keep your expectations, or hunker down your expectations, small and mid cap stocks.
Yeah. And more than that, I would say that the three more, and I would agree with all those broad points, but I think the bigger way to look at this is genuinely invest for the long term. Stretch your horizon. If you are a 1 year, 3 year investor, look at 5, 10, that's the time, that's the sort of longevity you should look at. Invest regularly, don't look at your portfolio that often, and every once in a while when the market craps out, put some serious money to work, right? It's not easy to do that. This is actually one of the world's easiest businesses. We have made it excessively complicated, right? But just if you stick to the knitting, you'll do reasonably well.
Like Manju used to say, always be prepared. Absolutely. Always be prepared, you don't know what's going to hit you. The funds you've managed, the schemes you've managed for over 25 years now, CAGR return has been just short of 20. That means in every 10 years, if I put the compounding is magnificent. If somebody has to genuinely take a 20-year horizon, can this kind of a return be anticipated in the next 20 years? I take a 20-year view. I'm making a SIP for my son. I'm making a SIP for my daughter. But if I take a 20-year view, can a 15 to 20% compounding still happen in India from these levels?
I mean, if you assume that this is an economy, well, at 20 years is, I mean, who has that kind of vision, right? I certainly don't. But if you assume for a fairly long period of time, right, 5-10 years at least, that India can grow at 6-7%, and you add another 4-5% of inflation, that's an economy which is growing 11-12%. You strip out agriculture and you're actually growing a little bit faster from what corporate India represents. And hence you're growing at 14-15%. So you can capture that kind of growth. There'll be some derating which may happen in some years and re-rating happens in other years. But over a long period of times, it's the growth which matters a little bit more than the valuations, right? Valuations matter a hell of a lot when you're investing from a 1 year, 3 year, 5 year standpoint. Investing for a 20-year standpoint, the valuations move over to growth from an importance standpoint. So I think 14-15% longer term returns is achievable. And then you hope, obviously, as funds will add some alpha, and alpha is becoming more and more challenging. But we hope to add a couple of points of alpha over and above that. But I think, to get 20 and those kind of numbers, those are when you invest in a cheap market, right?
In 20 years, you will get fewer instances when you invest more, when the downturn is happening, maybe equalization will happen.
Great returns are in cheap markets. Terrible returns are in fantastic markets. Otherwise, it all normalizes, right? So I think normal returns are more like 13-15%. I don't think that 20% is a normal return.
Final question: if Chirag Setalvad of 2024 meets Chirag Setalvad of 2000, what would you tell Chirag Setalvad of 2000? I'm sure you've had a lot of learnings, a lot of experiences, a lot of things you look back and say, okay, I wish I would have done it differently, or somebody told me that time.
I don't think there are any, there are obviously a lot of learnings. I think the big learning that a lot of investors have had, and I think has been a learning for me as well, is, there's been a lot of focus on valuations, and I think sometimes it's okay to pay a little bit more to own businesses which are inherently fantastic businesses where the management quality is great. So not to obsess only about valuations, but to also take into account the quality of the business and what compounding can really deliver over a period of time, right? So the Buffetts of the world have also had this journey, right?
From Graham to Buffett, yes.
And we've all learned from that, right?
All of us have a cheat sheet. I always carry a cheat sheet. What to read, what to write, what to follow, a quote. What does your cheat sheet have?
I don't have a cheat sheet per se.
No,
there's no cheat sheet. I think, as you get into your 50s, which is where I am right now, I think you want to have a more balanced life. So I always remind myself, right? I'm not a fund manager first, right? I'm a father first, son first, right? So I think it's important to keep that balance in perspective. So as I get older, that's the realization that I have.
That's a perfect advice. All of us should realize that we all have expiry date, like Sadhguru says. Markets will go up and down, but as long as you remain stable, and for that you need to live a long and happy life and a healthy life, I guess life is made. Thank you so very much. Pleasure as always. And it's taken 8 years for us to convince you to come. Hopefully next one before that.
Certainly. Thank you, Nikunj. It's always a pleasure.
Thank you very much.